explanation of the basics of an income statement. Balance sheet is a model of regularity compared to the income statement. Income statements, you're going to see a great deal of variability. You're going to see differences from industry to industry, but I'm trying to highlight here are some of the commonalities that you're going to find. And let's start with this thing that's on the top line, which I will refer to as the top line. It will have many different names. I have it listed here as operating revenue, but you may see it as gross sales. You may see it as just gross revenue, something along those lines. But what it's supposed to be is the broadest measure of earnings that are coming into the firm. I'm talking about sales and things like that. So it's the big measure of all the money that's starting to be funneled in there. You may find other kinds of revenue on the income statement, but this is the one that we're going to be focusing on for our analysis later on with our accounting ratios. Associated with this is going to be something called operating expenses. And the idea is that if you're going to have many different kinds of revenue, you also should have many different kinds of expenses. And these expenses should be tied to what was used in order to create that revenue. So the idea is if this is supposed to be a bunch of sales that you have, you may have your operating expenses listed as something like cost of goods sold. Okay, so again, there could be many different types of revenue here, but we're going to focus mainly on our later analysis on the one that's at the very top, we'll refer to as the top line. And in fact, when you hear that phrase, expanding the top line, what folks are talking about is trying to expand sales in some way. Now I've got the three dots here, the ellipsis, to indicate that there are a bunch of other different kinds of revenue and expenses that can be hanging around in there. And again, when we show you some real-life examples in class or online, you'll see some of the variability that's there in those different kinds of expenses. After that, you're going to find a kind of subheading that's there. It's called Earnings Before Interest and Taxes, and you'll see it as the acronym EBIT. On occasion, you'll see it as Earnings Before Interest, Taxes, and Depreciation. They're close to the same thing, but what it's supposed to indicate is the effectiveness of the firm of extracting benefits from the revenue and expenses, making it so that where the firm exists, so the taxes that are there doesn't matter because taxes can be different from place to place to place, and also abstracting from the interest expense, meaning the different kinds of capital structure that a firm may have. Firms have a choice of either borrowing money in order to finance expansion, or they have a choice of issuing new stock, or they can possibly go ahead and expand out of retained earnings. But this makes it so some of the tax distortions that are there don't necessarily reflect itself in this efficiency measure that's here, this earnings before interest and taxes. So you can think of this as kind of a subheading that the exact definition may float around a little bit, but earnings before interest and taxes, which I have it here, or earnings before interest, taxes, and depreciation are the two most common ones. Now after that, there are a series of special expenses that are singled out because they can be unusual. The first one is going to be interest expense, okay, and this is supposed to be the rent on money that you borrow. You may see things like net interest expense, in which case you'll possibly have a negative number, something along those lines, but it's supposed to be essentially the rent on money that's there. The next expense, which is unusual, is this depreciation expense. Depreciation is supposed to be the withering away of value that you're going to have in assets. It is singled out because it's a very, very, very unusual expense. While you should always take into account depreciation, keeps you from making bad decisions, it never is an expense that shows itself as a check that you're writing to somebody else. It's always you're simply noting that your car is withering away and becoming less useful over time, but you never give the check to anybody else. Still, you want to take into account that particular expense just so you don't do anything stupid. An example I had of folks not taking into account depreciation took place for a nonprofit organization that I was volunteering for a couple years ago. They were trying to do an auction, and in order to do the auction, what they needed to do was get some advertisements, and so they had created a bunch of large banners. These things are kind of expensive. They're about $350 each, and so what they did is they bought a few of them, about $1,500 worth, and the idea was that they could use these things over 3 years. Well, after they did the auction and they looked at the money they made from the auction, they had subtracted off the full cost of those banners and applied it to that particular auction as if it was the only year that they were going to see benefits from those banners. And they saw it and they went, oh, this is a terrible idea, we're never going to do it again. And I had to explain to them, no, you can use the banners over 3 years. And so what you need to do is, at the very least, just cut it into thirds so you can allocate those expenses to the revenue that you're actually generating. And once they did that, they thought the banner was a very good idea, and this auction is now in its 7th year as of the time that I'm recording this. So depreciation, again, very important expense, but it usually represents something that you're not writing a check to somebody else. Now, below that, you're going to find another kind of subheading, which is the taxable income. Taxable income is just supposed to be this operating revenue that you have up here, less all these expenses that we have listed out. Now, taxable revenue is nominally what you're going to be using to as a basis for the next line, which is taxes. But what you're going to find out is that taxes are not going to be as strongly related to taxable income as you would expect. And we'll start spotting this a little bit later on, because the average effective tax rates differ wildly across firms and differ wildly depending upon where you're located. And part of this has to do with what kind of business that you're in, what kind of tax credits are available to you. It also has to do with the skill of the folks that are on your accounting staff. Some people can actually do some interesting ways of combining particular purchases to make it so that your tax expense is lower than it would be otherwise. And again, the next line below is tax. The bottom line that we have here is net income, and net income is the bottom line, and that's what people are referring to. You may think of this as being the profits, but it's actually the flow of benefits that are available to the owners of the firm. In order to contrast this with the top line, when we talk about expanding the top line, we're talking about increasing sales. We're talking about expanding the bottom line. We're talking about expanding the profits, either doing that by contracting some of the expenses or going ahead and expanding the revenue up top, that top line. And this should complete the income